alternative venture. I would like to express our very sincere thanks to the NTU Entrepreneurship Society. And it's a big honor for us to be the first act on your calendar year. So thank you very much for having us. This evening, I would like to share a bit more about a financial instrument that's actually quite niche, but it's very novel and is a rising class of financing option for founders and entrepreneurs all across, not just Southeast Asia, but also globally as well. So what we're going to talk about in this masterclass is the following. We're going to give you a bit of background on venture debt, but not too much, right? So we want to make it a lecture as well. And then after this, we're going to share a bit about the internship experience, what it takes to be an investment analyst with a venture capital fund, right? Whether is it with Genesis, or with other funds that are, based in the region as well. And we're going to showcase some of the internship opportunities that's available, not just at Genesis, but also some of the portfolio companies that we have invested in, right? So today we have a portfolio of about 16 companies, a wide ranging of very exciting, fast-growing companies that's based all over Southeast Asia. And there's one in the US as well that's just gone public and listed on the NASDAQ last Friday. And we're going to showcase some of these opportunities for you guys. And some of these roles are actually current, but some of the roles will be available in the next couple of months as well, going into the end of the year. So there'll be opportunities for you guys to join some of these internship opportunities. And then we'll open up the floor for some Q&As. I'll get my intern, Kang Ying, who has been with us for almost 2 months now, and he will share a little bit about what an investment analyst goes through daily. And then also open up the floor for you guys to be able to ask your burning questions as well. Okay, so let's get the show going. So I think Chee Keng has kind of introduced me a little bit on the journey that I've taken to get to where I am today. Like many of you, I was a NTU postgraduate, and I did my master's in engineering after my undergraduate in Scotland, and I decided to take up a Singapore scholarship, and I was actually based in the School of Engineering Robotics Research Lab. Back then, I think the university campus was very different. It was very small, very few buildings, not like today. But I'm very glad to be back here today to be talking to some of the fellow NTU students as well. From my master's, after that, actually, I joined a startup company, a robotic startup company, right? From the master's degree, we got to know a company, an SME company in Singapore, right? Back then, the word startup was still not very popular. So there was an SME in Singapore who had won a contract from the Singapore Navy, and the Singapore Navy actually wanted to build 6 units of walking and swimming robots, right? So they needed some very geeky guys and lab scientists to go in there to engineer some of this stuff as well. And it was a very a great learning opportunity for me. To be able to manage a team, right? That includes, mechatronics engineers, electronics, robotics scientists as well. And together we put together quite a nice product. And the company eventually got acquired by one of the ST Engineering Group company as well. So from there, I went on to do my PhD. I continued my study journey. Went back to the UK to finish up my studies, and then did my postdoc at Imperial College. And then, Singapore came knocking on the door, right? That was where the Agency for Science, Technology and Research, ASTAR, began to start its foot. And I came back to Singapore to continue my postgraduate research work as well. And then from the academic route, I completely switched, 180 degrees and turned into a venture capital industry. Back in 2007, when the word investing and startup was just beginning to take off. From the equity side, that took me almost a 10-year career path. And I spent about half that 10-year actually in California and Silicon Valley, right in the heart where innovation is. And that's where my first brush with venture debt actually came by, right? So I was an equity investor. My firm had actually invested, into startup companies in the US, all across the US. And as part of the investment, actually, we do get an opportunity to sit on the board of the companies, right? So I had to be on the board of about 11 or 12 companies, and had to rub shoulder with some very experienced board members who are, seasoned venture capitalists as well. And in that process, we do have to help the companies to either expand into Asia, into Singapore. That's one of the investment mandate, but also to, help them to fundraise as well. And in that discovery journey, I actually found out about a product called venture debt, right? Very interestingly, debt financing for startup companies that are still massively loss-making, right? Some of the companies don't even have a single cent of revenue, right? And some of the companies are actually doing things that are very close to what we are going through today, right? mRNAs, vaccine. There's even a company that converted Botox, right, from an injected medium into a cream. So imagine for those who are very concerned about your skin and how tight your skin is, Botox is a very good medium for you to actually tighten it up, right? But you have to go through a lot of pain because the injection, the needles that you have to go through, the number of needle injections you have to go through is quite tremendous, right? Depending on how your skin quality is. And this company actually converted it into a cream, a topical cream. It raised a bunch of venture debt. It went IPO, and the company got acquired by, I believe it was Abbott Pharmaceuticals as well. So that equity, venture equity journey came to a bit of a temporary halt. When I came back to Singapore, and DBS Bank, headhunted me to start their venture debt practice. Right, DBS Bank is a lender, but they are not a specialist in venture lending, right? Which means basically you are providing debt to startup companies. And what DBS wanted to do was to be able to get into lending to a different group of customers, right? And they wanted someone with an experience and exposure to the Silicon Valley as well. So that's where I came in. And after about 3 or 4 years leading the team, building a very successful business there, I decided to do something different, right? I wanted to be an entrepreneur. I wanted to join the NTU Entrepreneurship Society, but it wasn't available back then. So I decided to go on the founder route and become an entrepreneur myself, right? So Genesis Alternative Ventures was born in 2018. I officially became a struggling founder, right? I had to take a pay cut of 50% from my last round pay, but it was a very enriching journey for me as well. Right, I'll tell you a little bit and describe the venture debt along the way. But also, throughout this whole 14, 15-year career, I also met a lot of very young and incredible founders as well. So I do dabble a little bit in angel investing, and I would encourage some of you to do the same as well. If you have spare pocket money, right, that you have made, from investing in Alibaba or Tencent, right? I hope you have already sold your stocks because those have really gone down. But with some spare cash, investing into early stage companies, right, can make you many times the multiples. It's almost like a Bitcoin type of investing, but this one is obviously a lot more legitimate, right? And as Chi King mentioned, I do a bit of adjunct lecturing along the side as well. So that's a bit of my non-linear career path, which is very long and windy. I should have taken a straight path there, but I decided to take the longer way around. Okay, let's jump straight into what venture debt is all about, right? But first, I think some of you might be new to the world of startup and equity and fundraising as well. So here is a very quick graphics, right, on what are some of the funding opportunities that are available for a startup company of a very young age all the way to growth stage, right? So if you look at the top right-hand corner, early stage. So if you are very early stage companies, 2 men with an idea on a piece of tissue paper, you'll be looking for some of these, green boxes funding options as well, right? So there's seed venture capital. Now there's more fanciful stuff like crowdfunding, and I was mentioning about angel investments as well. And then move to the next, a light blue column, which is growth stage. So as you grow and as your product matures and gets sold into the industry, then you become eligible for what you call venture capital, right? So there are funds that are actually out there who are looking for companies that want to raise funds and use that funds to grow very quickly as well, right? And then once you move towards a larger company, you get towards an exit stage, and then you have various options like IPO. More recently, in the last 2 years, SPAC was very popular. In fact, the company that went public last week, one of our portfolio companies, actually did it through a SPAC, right? And that's my first SPAC transaction. It was a very interesting journey for me. But along the way, something is missing, right? Debt is missing out of all these options, right? So I included debt into a growth stage as well. But of course, along the way, there's also growth debt when you get to an exit stage. So debt financing is actually another additional option that's open for founders and entrepreneurs to tap on when they're consider raising funds, okay? So the different types of funding rounds for your startup, these are the nomenclature of some of the description that you get familiar with. Pre-seed for very early stage companies that's in the proof of concept or in the prototyping side. There are probably 1 to 2 founders and hiring a small team there. And then when you get to the revenue stage, right? So once you start selling your product, you get to the Series A stage, you get into development, you get to hire people in the operation sides, you do brand and marketing, you can hire Sandra, who is an intern with us as well. And then you see the size of the investments actually grow a lot more bigger, right? From 10K to 1 million to 10 million, and then you get to Series B and Series Stage C as you increase your appetite for more funding as well, right? Okay, so these are all the different types of funding. And where does venture debt fit in? Venture debt actually fit in post-Series A, right? So the moment you get to a Series A funding stage, there would be some elements of venture debt that's actually available for you to actually tap on. Okay, next. So, there's venture capital, there's also private equity as well. The difference there really is the size and the maturity of the company, right? So venture capital, and the word venture actually means that, the companies are actually a lot more younger, they're a lot more innovative, and the fact that they are also, looking for a very high growth, right? Annual growth rate of, maybe 100 to 200%, right? Every year they're growing tremendously fast, right? And then on the right-hand side, you have private equity, right? So these are private equity funds that are investing into companies that are a little bit more established, but also a bit more traditional, right? So like your SMRT, your Comfort Del Grow as well, something not exciting as sexy, but the likelihood of failure in the private equity space is actually a lot lower. Okay, so the reason why the venture capital box is actually in red is because it's very risky. So you have to be very careful when you're investing for high risk, high return kind of investment. So where does venture debt sit in? Venture debt actually sit in between venture capital and private equity. And the reason for that is because the risk there is actually a lot more managed. When we go in and look for startups to invest in, right? We're not so keen on companies that actually can go from zero to unicorn within a year, right? We're not looking for companies that are burning excessively, but they are looking for a projectile growth that's in the form of a J curve, right? So that it can generate actually a moderate return as well. So we're not looking for very flattish kind of returns that are actually very bank-like. And we're looking for something that's actually in the middle, that sits in the middle between venture capital and private equity in terms of risk and in terms of rewards. Okay, next up. So really, what is venture debt, right? So if we look at the 2 squares below, on the right-hand side, you have equity, right? So when you invest equity into a company, essentially the company is exchanging shares or shareholdings in its cap table in exchange for the cash that's injected, right? So if you have $1 million and you want to invest in a company, and if the company gives you 20%, right, that you own 20% of the company in return for the $1 million of investment. On the left-hand side, there's the traditional debt. So that's the debt that actually banks actually give to companies as well. And these are actually more suited for traditional types of small and medium businesses. And what the debt actually gets in return in the form of lending, right, is actually interest rate. So you pay interest. And when you fully pay up your loan plus your interest, right, you don't lose any part of your company to the lender. Okay, so that's the traditional debt part. So when you stack venture and debt together, right, on top of it, that's where you get an exciting debt-like instrument with an equity-like returns. Okay, so this is the thing that you guys need to get a grip on, right? So basically, the investment comes in the form of a debt, right? So basically, we lend money to a startup company, right? In return, we get interest rates, right? So we still get an interest as well. So we are very similar to how a bank works. But on the other side, we also play the role of an equity investor because we get a warrant option, right? What does a warrant option mean? The warrant option basically means that Genesis gets the right to invest a proportion of the company, right, when the company becomes successful. So the right is for us to exercise at any point in time when we feel like it. Of course, there's a time limit to that, and typically the time limit is 7 to 10 years, right? Because a startup company can take anywhere between 10 to 12 years to get to that unicorn status that everybody is hankering after, right? So think about venture debt as a traditional debt instrument, right? That's actually bolted on to an equity warrant, and the combination of two, right? The two actually gives you the kind of returns that straddles in between debt and equity. So it's a very interesting type of financing instrument, and it's also very beneficial for the company as well. And I'll show you next how it works, right? So let's assume, right, that this is a Series B company that's actually looking for a $10 million funding. Okay, so let's look at the top row first. Okay, don't ignore the bottom row. $10 million funding, and typically how a founder will go out there to do is you raise 10 million in equity, correct? And let's assume that in exchange for 25% of the company, right, he gives away 1/4 of the shares to the investors that are willing to put in $10 million into the company, okay? So now, look at the bottom row, right? Same company, Series B funding, raising $10 million, but instead, the founder actually takes $3 million in debt, and he reduces his equity to $7 million, right? So the net result is that he still gets $10 million in funding, right? But because he only raises $7 million in equity, right? Now he only gives away 20% of the shares of the company, all right? And he gives 1% of a warrant option to Genesis. So altogether, he actually gives up 21% of the company in exchange for the same $10 million of funding, right? He doesn't get any cent less than what he was previously looking for. But the difference is that he actually gets to save 4% of the company for himself, right? So if every single round he saves 4%, 5%, 4%, 5%, he gets to keep a lot of company for himself as well. So it's good for the founder, it's good for the company, and it's also good for the VCs who are investing in the company because they also get to keep more of the companies to themselves, okay? This is another way of looking at it. Same company, Series B funding, $10 million, goes out there to raise equity, 25% shareholding, right? Look at the bottom line now. Series B funding, he raised $7 million. He raised, wait, hang on. So not this one. This one, yeah, sorry. So look at the bottom line now. He raised 10 million. The bottom line, he raised 10 million in equity, but additional 3 million in debt, right? So now the company has 13 million of capital instead of 10. How much of the company does he have to give up in order to raise the 13 million? Now the 25% in exchange for the 10 million plus another 1% for the 3 million of debt. right? So for the founder, he now has 13 million instead of 10, but he gives away 26% of the company, right? What advantage does this founder have now? The founder actually has $3 more million to go and actually of capital, right? To go and do more stuff, right? He can hire more people. He can expand into a new country, Indonesia, Vietnam, or whatever. He can bring a new product to the market much faster as well. So in a nutshell, he can use that capital to become a market leader with a product very quickly as well, right? But he doesn't give away a lot of the company very early upfront, okay? So when it comes to raising doing fundraising, right, the cost of capital is something that's very important, and I think if you are in the entrepreneurship society and your aspiration is to become an entrepreneur, you really need to understand your numbers very well. How expensive is the capital that you're actually raising and you're bringing into the company, right, in exchange for either interest rate, warrants, or even the shares in the company. So when you look at the cost of debt versus equity, right? So we start from the right-hand side of this slide, right? Venture capital, in some founders' opinion, right? They think actually venture capital is the cheapest. And some founders even told me that actually VC equity is actually free. Right? Because when they run out of the $10 million, what do? They go out there to raise again, right? They raise another $10 million, they spend it, they go out there to raise another 10 more million, right? But what is the cost to the founder? He gives away 100% of the company, right? Once that shares is actually out the door, that means once you've given out the shares, right, you don't get it back anymore, right? So that's why in terms of cost, right, equity fundraising is the highest, okay? Then we go all the way back to the left-hand side, to the traditional debt. Traditional debt is the cheapest form of financing, right? Because you're only paying an interest, you don't give any equity stake out the door, is the cheapest. So why don't startup and founders go and raise traditional debt? Because it's not available to them, right? Because they don't have a track record of generating revenues and profits, right? So the banks don't know how to deal with them, and the banks decide not to lend to them, right? So that in the middle there is a very nice instrument called debt financing, right? And if you look at the blended cost of capital, right, whether you're doing venture debt or factoring or accounts receivable financing, right, the blended cost of capital actually stays quite reasonable, right? Because you only give a little bit of the company away, but you get the same amount of capital. The one disadvantage there is that you have to repay the debt, right? You have to repay the debt at the end of the day. So here I need to state the fact, right? I'm not saying that venture capital is not good. I'm not telling NTU Entrepreneurship Society members to not raise or to boycott VC equity. No. VC equity is very important, right? It is important for funding innovation, for taking risks in early stage companies. Is a very important part of the funding ecosystem. And venture debt is actually a complement to venture equity in the whole venture capital industry, right? It works alongside VC's equity as well, okay? But when you look at the cost of capital, right, then you have to decide at a point in time when venture debt is actually available for you to choose, right? Then you got to start looking at actually raising some blend of capital in order to reduce that cost of capital down, okay? So what is venture debt? Most of you would not have heard about venture debt before, right? So is venture debt real? And what has it? How long a history has it been around for? Right? Venture debt has been around for almost 5 decades, right? Companies like Apple, Hewlett-Packard, Facebook, Airbnb, all of these guys have raised venture debt before, right? It's not a very well-known instrument because it's not been widely publicized. Lenders tends to be a lot more conservative. Lenders don't like to be on social media as much as the VCs, so they don't. The funding rounds actually don't get published out. But if you look at this this chart that's on the slide right now, from 2017 to 2020, right? The gray portions actually represent the equity financing that goes into startup companies. The blue portion is actually the venture debt that US startups have actually raised, okay? And between 2018, 2019, and 2020, the three blue bars actually represents $100 billion worth of venture debt that has been invested into startup companies. So it's not a small financing option. It's a very big proportion of the equity that's been raised. In fact, it's about the proportion will be about 20 to 30%, right, of the equity that all the startups in the US have actually raised, right? And the larger the company is, the more venture debt they will take on. So I give you an example. Airbnb last year, right? April of 2020, they were in deep trouble because there was no travels around, right? Nobody was going traveling, nobody was going vacation. So, you know, their business completely stopped, right? So Airbnb had an option to raise equity. They also have an option to raise debt as well, right? And they decided to choose debt, right? They took on $2 billion of venture debt or growth debt, because if they were to have raised equity in April of 2020, they would have been severely diluted because of the down round of financing, right? So growth debt or venture debt is actually a very good option for companies that are actually doing very well, but need a bit of cash to step it on as well. So let's move back to Southeast Asia, and whereabouts is venture debt to Southeast Asia is quite new. So when I started DBS venture debt business in 2015, right, there was very little venture debt around, right? The red bars in the graph there actually shows the equity financing that's gone into Southeast Asia startups, right? Not just Singapore, but Indonesia and across Malaysia, Thailand, Vietnam as well. Those are very well publicized. Again, there's a lot of public information about, you know, which company raised. Hello, can you guys still see me? You can. Okay, good. And the gray bars actually shows the venture debt part of the business, right? And there's very little information about venture debt. So we have taken a guesstimate approach, right, to looking at those numbers. And this is a published report by Genesis and Pricewaterhouse Singapore to try and actually measure what is the amount of venture debt that would have been available for startup companies if they were to raise it as a proportion of the equity funding that was available, right? So we take a conservative 10%. So 10% or 5 to 10% of the equity side, right, is what we are representing in terms of the gray portion. So if you look at 2020, there would have been at least, you know, $800 million worth of venture debt that would have gone in to startup companies if they would have raised that, right? Today, it's still not a very well-known financing instrument. We're continuing to do talks like this, right, to help people to understand that the availability of venture debt and to encourage startup founders to actually go out there to raise it. So really iconic names raise venture or growth debt in different stages as well, right? And these are the names that have actually gone out there to do. So the companies that went public, one of our portfolio companies is called Metapod. Very exciting company. They did very well in COVID. Last year, April 2020, they actually help a lot of the property agents, right, go digital by digitizing the you know, build up environment that you're in, right? The room that you're in can actually be digitized in 2 minutes and then be used that as you know, a showroom as well, right? Facebook, Airbnb, and even Grab, right? So if you look at Grab, the announcement today, every single round of financing now that they do, it's all in debt already. So they have already gone from raising equity, they've completely given up on that, but they've just gone on to focus on raising debt. So debt becomes a very important part of the startup journey as the company goes on in its later part of its startup life. So coming back to Genesis, right? Genesis, really, the motto is to empower growth to help founders, right, to be able to deliver the growth that they're looking for while minimizing dilution, right? And we are a Singapore-based Southeast Asia venture debt fund, and we only provide venture debt to venture-backed companies. And what do I mean by that, right? Effectively, venture-backed companies are the ones that actually have venture capital investors on their cap table. Okay, starting from the left, Genesis Fund 1, we just closed it 2 weeks ago. We are $85 million fund. And at the back of us, we have quite a number of bank investors. Banks don't really understand startup companies very well. So they chose to work with a private fund like us and use us as kind of the springboard to understanding how startup works. The target company that we are looking for, right, are typically Series A, Series B, and beyond, right? And we can write anything, check size of between $2 to $10 million. And instead of an industry focus on, robotics or AI or whatever, we actually look for a sector or what we call a business model focus, right? We tend to favor business to business type of business model, right? So if you're selling to businesses instead of selling to consumers like you and me, that's what we are looking for. And we do fund some of the B2C companies, right? Like the buy now, pay later type of companies as well. These companies will raise venture debt for doing a few things. They want to raise it for growth and working capital. In a later stage company, they might be looking to acquire small companies to actually speed up their growth, or as an insurance buffer, right? Many founders tell you that, this year I'll grow by 100%, next year I'll grow by 200%, the year after will be 300%, right? But if you put all the financial statements of these companies together, they barely meet 50% of those targeted that projected, right? Entrepreneurs are meant to be very optimistic, and you have to maintain that optimism in you. But at the same time, you also have to be a bit realistic as well, right? So selling a product to a new customer is never easy. And then once you sold the product and you want to keep the customer, is even much more difficult than that. Okay. These are some of the companies and some of the VCs that we work along with. So starting from the top left-hand corner, we work with some of the top tier, Southeast Asia and global VCs as well. Iconic names like Excel, Alpha JWC, Sequoia Capital, Excel Partners, Wavemaker, Vertex, you name it, we know them all. And then if you look at the portfolio companies that we have there, very interesting, very diversified, from fintech to proptech to agri-tech, to cybersecurity, and some of the commerce companies that are propelling some of the new business model around Southeast Asia as well. And then on the right-hand side, most of the companies that we invest in serve, actually a global business base out of Southeast Asia and at least 12 countries, that you see out there. So my advice to founders, right, and I know it's a bit too late in the night to give you a bit of scare as well, but founders with ambitious aspiration needs capital to scale, okay? This is a given, all right? If you are in the business of starting a company that is doing a tremendous projectile growth, right, you need capital, right? And we always talk to founders who says, look, I have $1 million in the bank that will last me for 6 months. Let me burn through that 6 months first. At the end of the 5th month, I'll come look for you. Maybe you can lend me some money, right? And the advice would be, money is easy when you don't need it, right? That means now if you have 6 months of capital, you can actually borrow 6 more months. But money is actually very hard to find when you desperately need it, right? So at the end of the 5th month, if your business is growing tremendously well, everybody would want to invest money in you. But if you are not doing as great as you have projected your business to be, then money is going to be extremely hard to find when you desperately need it. Okay, so switching gear from talking about venture debt, right, to really, the career journey of being an investment analyst. What are some of the skills, the life experience, and the mistakes that you have to make, right, to get there? I think beyond, being an accounting undergrad or being a business undergrad or being an engineering undergrad, right? A lot of people actually, or a lot of the young students actually forgo that understanding that actually there's a lot of soft skills that is required, right? There's a lot of relationship management skill. a fund can invest money into a startup company, but first of all, you actually have to convince the company why they have to take money from you, right? So in effect, it's a sales job, right? So there's a lot of relationship management skills there, a lot of marketing and sales skills, a lot of organization skills as well, because you have to be working on different projects at the same time. You have to communicate well. You'll be put in front of, actual investment committee. You'll be asked to write a piece of, memorandum for you to justify whether we should be investing into certain companies or not. And at the end of the day, it's all about problem-solving skills, right? So if you have all these 5 soft skills there, whether you're from business, accounting or engineering, it doesn't matter. You will have a very good career in the venture capital industry. And a lot of the candidates that interview with me, right, ask me, so what does it take to be an investment analyst, right? So what must I know? You know what you don't, and if you don't, then read, right? Read extensively. There's a lot of articles today that talks about why a company succeeds, why a company fails, and reading will allow you to get exposed, right, to different types of startup companies as well. And then on the right hand side, you got to be like that little boy there, right? You got to have that curiosity mind. You got to ask about why Grab, how does Grab make money, right? How does Gojek actually deliver, or how does Gojek know where you are, what you're looking for, right? And then bring that food and deliver it to you, right? How do they actually do that, right? Technology touches everything that we do today, right? Surrounding you today, when you buy groceries, to buying your laptop, to buying flowers for your boyfriends and girlfriends as well. You use a mobile app and a smartphone, and a lot of the financial technology that goes into the payment side of things as well. So there's no excuse for you not to know what your favorite startup is, right? Because you will be using a lot of all this technology in order for you to be able to get your life going, right? So with that in mind, actually what I want to do is to hand the time over to Kang Ying, and Kang Ying will talk through a little bit about his short journey with us, but he still have another few more months to go. But I think he has gone through quite a bit of a pain now, so he has aged quite a bit already. But I'm sure he has some great things to share with you. So over to you, Kang Ying.
Thanks, Dr. Loh. So hi, everybody. Kang Ying here. So I'm actually a year 3. Okay, not so much year 3. I'm a just completed year 2, going on to year 3 accountancy and business student in NTU. And yeah, just a little bit about my NTU life. So I was in Tanjung Hall, but probably not anymore after the fiasco. I was also in Nanyang Capital. Yeah, so that's my CCA. And yeah, so I joined Genesis in May to do my summer, and I'll be extending with an LOA until November. So today maybe I'll just talk a little bit about what I've done so far as an investment analyst intern at Genesis. So what you see over here, the bullet points, right, is really the entire process of looking at a new company and eventually putting it into our portfolio and following up by monitoring it. So you get to do, you get to participate and even lead along every step of this journey as an investment analyst. So firstly, we listen to founders pitch their companies, we ask questions, and we also understand their business and funding needs. So by companies, right, I think as Jeremy shared, we are talking about all kinds of tech-enabled companies. You have like e-commerce companies, deep tech companies, fintech, or any kind of tech, right? So you really get to see this whole range of different kinds of business models and really build that muscle memory such that you can actually be more familiar, when you look at businesses in the future. So yeah, that's what we do. Maybe like 2 to 3 times a week, you get to go onto a call and you ask questions really just to understand what people are doing with their businesses. So if we deem that this is a business that is qualified for us, right? So by qualified, I mean they meet certain milestones, like maybe they have a certain amount of venture capital backing, or they have enough revenue traction, then this is a business that we can potentially look at. So that's when the analysts will really come in and do the preliminary due diligence. So I think this is really the bread and butter of an analyst, right? Where you actually analyze the business. And what we're looking for most of the time is the business model, and in particular, the unit economics. So what I mean by this is really like for each unit of goods that you sell, are you generating enough margin to pay off your fixed costs? And if you're not generating enough margin, then with scale, will you be able to? So these are some very important questions that we like to look into, and also a little bit about the financial statements. So in particular, the cash flow statement is very important to us because we do need to pay off the debt that the companies do need to pay off the debt that they borrow from us. And we also look a little bit at the industry and competition. So at the end of the week, right, usually we will have a weekly deals meeting. Okay, so it looks something like the picture over here. You have the whole team out there, all the partners and senior members, and we will just share about the companies that we've seen throughout the week. So usually, as an analyst, you prepare a slide, a slide deck, about 7 to 8 slides for each company, and you just present to the team your thoughts in the form of some merits and risks of the deal. And that's when we'll open up to the floor to discuss. And actually, this is where a lot of my learning comes from, because you get to hear all these war stories, from all our partners and senior members who have had experience with maybe similar companies and just a lot of investing experience. So they share, whether this is a good deal or a bad deal, and basically whether it is something that excites us, whether it's something that we should look deeper into. So if it is, right, then the real work actually starts. And that's when we do a full due diligence process, prepare a presentation for the investment committee. And at the end of this whole thing, that's when we actually add the company into our portfolio. So this entire process, right, that I've just covered is most of what you'll be doing if you do join as an investment analyst intern. But occasionally, we do have to also keep track of the companies that we already invested in. So that's the portfolio updates and monitoring side. So usually this one is like every month, companies will send us some of their updated business metrics, some financials, and we really just have to put it into a good format, analyze it a bit, and present it to the rest of the team in the form of an email blast usually. But this is not so much the job of an analyst intern. I think most of the time, the full-timers will be tracking the companies because they are a bit more familiar. So yeah, as an intern, you get to do the more exciting things, which is really just to look at all the new companies and generate some thoughts on them. Of course, occasionally there will also be like some ad hoc duties, right? I think that's quite common for most internships. So for me, I've done stuff like equity raise tracking, also like maybe some marketing stuff as well. And I think that's very common for most internships. But the good thing is that at Genesis, they are generally very concerned about your development as an intern. So you don't need to worry about doing like coffee runs or sweeping the floor. Like that's not too much of a concern. Most of the time as an investment analyst, I would say 99% of the time, yeah, analyzing things. So that's one good thing about Genesis.
There was a question just now from someone with regards to how can I know when is a good time to seek for venture debt, right? As I mentioned earlier on in the earlier part of the presentation, if we go by series funding, typically it will be Series B, but we do look for outstanding Series A companies as well. So for example, Pace is a Series A company, Paramat is a Series A company as well, Hamlet is a Series B company, but these are not very fixed in terms of whether they must be strictly Series A or B, right? We look at the how the company has been performing, how much funding they have received, what's their growth potential, what's their revenue, and etc., etc. So it can be quite fluid and not very rigid in this respect.
Hi. May I raise a question, please?
Yes, please. Go ahead.
Hi. So first of all, I think we owe to say thank you to the Genesis team as well as the NTU Entrepreneur Society for hosting us today. And thank you, Dr. Jeremy Loh, for actually accommodating us today. My question would be that I caught on just now that you talked about the J curve, right? I assume that would be the interim IRR, the internal rates of returns, based on the front-loaded expenses and back-loaded revenues. So my question would be, how do you discern? I believe that as a venture capital fund, you probably receive a lot of pitches from a lot of businesses around. So how do you discern a good or sustainable business model from the rest?
Yeah, so on that J curve question, right? The J curve refers to the rate of growth, right? And the rate of growth could be, measured by, their top line revenue or their bottom line EBITDA as well. Not so much on the internal rate of returns, which is really a measure of the investment success, right? And then on your second question, which is really about, sorry, what was the second question again? The second part of the question?
How do you actually discern a good or sustainable business model from the rest that you receive?
So it all stems from the referrals, right? When someone refer a deal to us, actually that determines whether the deal is ripe for the picking, right? So unlike a lot of the VC funds who actually go out there to source for deals, we get deal referrals from our VC partners, right? So we cultivate a lot our VC partners, right? We talk to Sequoia Capital, we talk to Vertex. Hey, you invested in this company. How are they doing, right? Are they, doing well? Is that going to be suitable for them at any point in time? Let me speak to the founders. If they're not raising debt today, they might be raising debt tomorrow, right? So the deal referrals comes very warm from the VCs. When they start raising Series B, then at the back of their mind, they'll start thinking about Genesis as well. So about 80% of our deals actually comes from the VCs. The remaining 15% actually comes from founders who knows us very well because we've been operating as venture lenders for the last 6 years. And this is probably the longest for any venture lenders operating in this region. And the last 5% actually comes from third-party guys from like brokers and so on and so forth, right? So deal referral is a very important part of the criteria for us.
I think also, right, maybe to push the question a little bit about looking into portfolio startups, right? So given that there's so many successful ones, I believe you also have your own challenges, right? So is there like any red flags, like in terms of identifying all this kind of different startups that you want to fund them in this case?
Yeah, so that's a very good question. So one of the key criteria, right, is actually we fund companies that are actually very well funded, right? Actually, they have cash, right? So in the example of that Series B funding, whether they give up 25% stakeholding or not, these companies have money in the bank, right? We are not the last resort of financing. So you don't come to a venture lender when you have no money, right? If today you only have $1 in the pocket and you need some money in the bank tomorrow, don't look for a lender, right? Look for an equity investor, right? When the equity investor come in, then alongside that, the debt provider can actually come in alongside the equity investor as well. Okay, so I have a question here who asks about safe notes, right? May I ask conceptually whether you consider simple agreement safe notes as a venture debt? No. So the one thing that I want to clarify here is that venture debt does not equals to convertible debt, right? We are a straight debt, meaning that the debt needs to be repaid 100%. Okay, imagine buying a house, right? Or taking a credit card loan for, buying something that you like, whether is it a expensive Hermes, bag or laptop, right? You need to repay the debt, right? If you don't repay the debt, the items that you own actually belongs to the lender. A convertible note, on the other hand, it's a quasi-equity, right? Meaning that these are actually investors who sit on the fence, right? Remember Humpty Dumpty, right? Humpty Dumpty sit on the fence. And depending on which side of the fence is actually better looking, they will decide to go on either side. So if the company is doing very well, they will convert everything into equity. But if the company is not doing very well, they will convert everything into debt, right? So these investors are a little bit, unclear about what they're looking for at this point in time, right? But if they turn everything into equity, then it could become, remember the cost of capital, it can become very expensive. But if they switch to debt, right, means that actually the company is not doing well, but anyway, they can't repay the debt as well. So I think that's a very strong distinction between venture debt and all other forms of convertible debt, whether it's safe notes or what have you. I think there was a question about, do students have to be strictly accounting background for them to take up the intern? No, right? I'm an engineering graduate as well. I think you have to have that soft skills, right? We're looking for people with the soft skills, right? People who can sell, people who can think, people who can problem solve, right? And people who are really curious about why a startup exists, right? And it's not about, whether of course you have to read a financial statement, right? But you can learn. You have to do Excel modeling. You can learn, right? A lot of the technical skills can actually be acquired, but the soft skills are the one. If you can't think critically, right? If you don't read, right? If all you do is play games, but you don't read, right? You don't know what's happening out there. You don't know where your food is being delivered from, whether you're ordering from GrabFood or Deliveroo, right? Then you're not suitable for that role, right? But if you really are very curious about how they make money, right? What's their margins? When you pay to the driver, right? What goes to the driver's pocket? What goes to the food delivery platform in terms of commission, right? Why are the hawker centers, food stall holders all complaining today, right? When they are on Grab and Deliveroo. Think about it. Have you thought about this question, right? Go and think about it and come back to me with some interesting question, and I would love to have a chat with you guys as well. So there's another question. How much fund is the company currently managing? Okay, so someone didn't haven't been paying attention to the slides, right? Can someone answer it for me? How much money is Genesis managing? Anybody? Anybody paying attention? No, all 59 of you? Yeah. Let me move back a bit. There you go. Magical number, $85 million.
Oh, Eric got it right. He said in the chat.
Okay.
Hi, Dr. Low. May I ask a question?
Sure.
Regarding your debt to equity mix, what's the usual percentage split that you go for? And regarding your debt, because I will assume that most of it will be unsecured, where on the waterfall structure would your debt typically lie? And,
excellent question. So,
and the
Gerard,
returns as well, yeah, thanks.
Okay, so debt to equity ratio is typically, so one thing that a lender doesn't want to do is to over leverage the company, right? If I give 100% of all the capital that the company needs in debt, then the company will be gone tomorrow because all they do is have to service the debt. So the debt to equity ratio is typically 70% equity, up to a maximum of 30% debt, right? And the way that I would advise founders is to start small, right? Don't go to a lender tomorrow and say, I need $100 million in debt, right? Can you provide me with the funding? A lender needs to get comfortable with a few things, your track record, right? The ability to repay, right? Start with $500,000, start with a $1 million debt, right? And then slowly build your track record. So when I first landed in the US, right, with my previous job, and I was an executive with a proper pay, right, and the government sent me to the US as well, but I can't get a credit card in the US because I don't have a credit track record, right? So first of all, they give me the charge card. What does a charge card mean, right? It means that if I put $1,000 onto the charge card, I can sign up to $1,000 of credit, because they know I have the ability to pay $1,000, right? But once I start there, then I increase it to 2,000, I increase it to 3,000, and before you know it, right, 15 credit card companies are coming to me, Amex, Chase, right? Everybody's coming to me and giving me like unlimited credit limit. So you got to start building your credit history, whether you're individual or you're a startup or a small company, right? Start building your credit track record. Don't do anything wrong, right? Don't pay late. Don't pay your bills late. That's the number one bad thing to do, whether you're individual or a business. Okay, and then on the your question about on the capital stack, right? Lenders always sit on the top of the liquidation stack, right? So lenders have the first right, followed by senior secured debt, followed by unsecured debt, followed by mezzanine debt, followed by preferred equity, common equity, and then everyone else below.
Yeah, but so for your kind of venture debt, where would you sit?
On top, right on top, because typically we are the first lender, right? Because the company doesn't have any track record and they can't go to a bank as well. So we will typically be the most senior lender. But as they grow, then they will definitely get more lenders in.
What is the rate of return on this sort of debt?
What do you think?
What's the margin like? 7, 10?
A bit more than that, right? So 7, 10 actually, if you think about it, interest rate of 7 to 10 actually, having worked in a bank before, right? It depends on whether you're secured debt or unsecured debt, and even with the secured debt, with personal guarantee, actually some of the small medium enterprises are paying anything upwards between 5 to 10%. So for venture debt, it will be upwards of 10%, because these companies they might be here today, they might be gone tomorrow, right? So the risk is there, but of course we do look at the company very closely before we lend a single cent to them, because we're in it to make money with them, right? We don't want to strangle the company so that they die. If they die, we don't benefit at all. So in this relationship, right, there are three winners. The founder wins, the company wins, right? The second winner is the venture capital investor as well. They put in money early upfront. And then the third winner is a venture lender, right? So we want to have a win-win-win situation with all these three parties equally happy with the outcome.
Okay. Interesting. Thanks.
No problem.
On that note, right, I think one of the hottest and spiciest question is, are you able to review what was your most profitable investment thus far?
Oh yeah, wow, okay. Thus far, definitely the company that went public last week, right? The company listed at a valuation is public, right? So they listed at the valuation of about 4 billion. And we went in at the valuation when it's triple-digit millions, right? So you can go and do the calculation now. So it's good, but there's a lot of heart-stopping moments, right? So we provided the debt to them last April, right in the middle of COVID, right when Singapore was closing down its border, when the rest of the world are shutting down from each other. And after we have given the debt to this company, right, actually they started cutting their headcount, right? Because startup companies have this flexibility of being very nimble, right? They can grow very fast. They can grow from 10 people to 1,000 people within a space of 6 months, but they can also go from 1,000 people back down to 10 people, within a space of 6 months as well. So this ability to be nimble, right, actually allows them to be very, to have that survival instinct, so that as to grow with the, with the macroeconomic conditions as well, and to capitalize on, venture capital funding, which is expensive, but which is very necessary for them in order for them to become market leaders, right? So for us, the ultimate aim will be for a company that in our portfolio company to go IPO or be acquired by another entity as well. And I would have to say that will be one of our most profitable ones today.
Okay, so for those of you who asked the question, I think you can do your own calculations. I think there's a question from the floor. What do you think is the best use of the founders to use the venture debt to grow their business? And are there any things they should avoid? Because it's, yeah.
Excellent question. So I think, debt and equity has, in the capital stack of a company, right, has its own dedicated use of proceeds, right? You raise equity for doing things that are actually very risk-taking. So for example, you want to create a new product, right? You want to take an idea to a prototype to a product, use equity. But you see, once you start selling that product, right, and you know that the consumers or the businesses are buying, right, and there's repeat buying patterns, right, you don't use equity to fund that, you use debt to fund the growth. So if you think about this two pool of capital, right, equity and debt, and their specific use of proceeds, then you will be able to see how and why debt can actually exist alongside equity in the startup space. So there's a question, you let the intern look at the new company. How can you ensure that the company is well looked after? It's your money after all. Of course, it's my money after all, because I always ask Kang in this question, right? So you say you would recommend us to invest. So would you take out your money now, right? Take out your money now, empty your wallets, and put the money alongside us, right? So the same question is that while we let the interns run the show, but we make sure that we guide them along the way, right? We don't, just close our eyes and then open up our wallets and write a check when our interns say so, right? They do make mistakes. We do make mistakes as well. We all learn together. But at the same time, we are looking after money that our investors have entrusted us with. So if you look at all the logos out there, right? There are 4 banks out there, right? They have entrusted the money to us, not because we like to write checks, with a lot of zeros, right? But because we like to protect their money. We like to make sure that their money is not only protected, but that's the rate of returns that they're actually looking for, right? Can come from an investment into Genesis Alternative Ventures.
So has Kang Ying put in his own money before into the entire fund itself?
If I could, I would.
Okay. Oh, there was also another question about breaking into the VC or venture debt space, right? Do usually grads, like people just graduate from university, can they just break into the space, or do they pivot away or pivot into it from like startups and consulting or IB, for example?
Yeah. So the venture capital industry, right? Whether you're looking at a venture equity fund or venture debt fund, actually the skill sets are actually quite complementary. Other than the soft skills, typically, accounting, engineering, or even business grads, MBAs, have been known to, even PhDs have been known to join the venture capital industry as well, right? You do have to actually make mistakes before you start learning, what went wrong with the investments, right? So for me, my best experience, right, in this 14, 15 years of my career is not the successful exits that I have, right? But it's the mistakes that we made, right? As an investing professional, what happened to the company that went wrong, right? Why did the company die, right? Why was the company not able to survive when another competitor actually did much better? What went wrong, right? Was it management mistake, right? Was it fraud? Or was it just because the business is not viable at all, right? So if you take that kind of attitude, right, whether you join an equity fund or a debt fund, the debt fund does require some additional credit skills, right? Other than the skill set that a venture equity investment analyst would have, what the venture debt funds are actually looking for is that credit skills, right? So if you think about the 2 funds lying side to side, right, the equity guys are actually going for high risk, high return, right? I will invest in 100 companies. 99 of them can die. 1 company can make all the money that I've lost in the 99 investments. But for a venture debt fund, it's the other way around. We want to make sure that 100% of all the companies that we invest in don't go down, right? We want to maintain a pristine 0% loss ratio, right? We'll have some losses, small losses, right? 2-3% maximum. But we can't afford to have like, the whole company go down or 10 company goes down. That's not, it's a very different risk mindset, right? We're not chonging all the way, but we're taking very careful look and making sure that the company is right for the debt taking before we actually invest in them.
Okay, Ken, thank you. Maybe also because we kind of overshot a little bit, maybe just to wrap up the entire conversation, right? Maybe Dr. Jeremy, in your own opinion, there might be a lot of aspiring entrepreneurs here that want to find the next unicorn or want to build the next rising startup. What do you think are the rising trends in the entrepreneurship space in the next 5 years, 3 to 5 years?
So, well, I've seen a lot of different cycles, right? I've seen healthcare space, take off and then come back down again. In my career, I've also seen the clean tech space come on and then take off again, right? We were invested in a company that's doing electric vehicle back in 2009, right? Today, everybody's talking about electric vehicle, but imagine 12 years ago, right? The battery is done, the car is done, everything is all done, the manufacturing plant is done, but the company can't take off because the timing is not right. So for an entrepreneur, you need to be able to look around you, right? You need to look around you and see what are the most painful problems that you can solve with the fastest, cheapest, right? And the most available option that's out there for you, right? Buy now, pay later. Think about buy now, pay later, right? It's a financing option that's been around for donkey years, right? It's, installment payments is nothing new, right? But they have taken it one step ahead, right? They made it into like 3-4 installments, very easy to digest. They use the mobile app and bingo, right? You have it there. So you can't tell an entrepreneur, okay, today you have to go and look for a problem that actually is in the electric vehicle space or in the healthcare space. The entrepreneur has to be able to empathize with the problem itself, right? And to be able to see that actually, if I can solve this problem, I cannot benefit 1 billion people, right? And if you have that mindset to do that, right, then you'll be on the right path of entrepreneurship. An entrepreneur needs to not deal with success at first, right? They need to deal with failure first. I've seen in my 5 years in California and in the right in the middle of Silicon Valley, right? I've come across entrepreneurs who have failed 3 times. And when I meet them, they say, I'm on my 4th startup, right? And I ask them, why don't you just give up? But they say, I know that I'm getting there. Every time I fail, I'm closer to success. And I also, on the other extreme, right, I met like entrepreneurs who have been on 4 different companies and he's on to his 5th one, right? Of the 4 companies, 3 went IPO, 1 got acquired. So I said, why don't you retire, buy an island and go and play golf or something, right? He says, no, it's just in my nature to be an entrepreneur, right? And if I don't solve problems and if I don't create something, I guess I can't sit still. So for an entrepreneur, and especially for you guys as a society that's actually promoting entrepreneurship, right? I think it's very important to cultivate that mindset. Asian countries and the Asians in general, right, are very skeptical to failure, right? When you don't get 100 marks for your maths exam, right? Everybody thinks you're a failure, right? Because you just missed it by 1 mark. But if we can accept failure with a lot more open arms and open-mindedness, I think there will be a lot more entrepreneurs and successful companies coming our way.
Okay, I think it's a very solid tip for all of you out there to adopt this mindset and to identify the idea of scalability in terms of how you solve the problem. I think one last question from Gerald. He wants to ask about, with the average ticket size of 2 to 10 million, would you have sufficient skin in the game?
Yeah, I think so, because we are in companies that are actually looking to scale, right? I think the word is scalability that you mentioned, right? And as I mentioned earlier on, a lending relationship is a long-term relationship, right? It's almost like marrying the girl that you meet in the university, right? You don't want to just date her and then just continue dating many different people. A lender needs to be in the long-term relationship with the founder and the company to take him from Series A, B all the way to an IPO process as well. So we can go in with a $2 million checks, and eventually we can go in with a $10 million commitment. And when we get there, right, our investors are the ones that are actually coming to us and say, look, we need to deploy 20, 30, 40, $50 million into companies. Find us an opportunity. And while we are cultivating these portfolio companies on the way, right, we are preparing them for the next stage of the lender. So we don't pretend to be, the do-it-all lender, right? Eventually, some other lenders will take over, and we are happy to hand it over to the next lender because we know they are in a better hand when the next lender comes in.
Okay, Ken, thank you. I think through this short 1 hour sharing, most, if not all of us, including myself, of course, was able to gain a deeper appreciation in the entire venture debt space.